Hey everyone, thanks for watching today's video tutorial training educational session on how to use your 401k to buy a house. And we're going to be talking about using that 401k to source your qualifying income as well as your down payment money right there. So a lot of people know that you can use the 401k and you could withdraw money from that and put it down, use that as a down payment on a house. You know, you could take a straight withdrawal from the 401k. And you could take then a 401k loan, usually you could withdraw about half, and then you could take a loan for the other half, you know, for whatever's in there. So they kind of slice it down. There's some fees and things like that. That's one way to get the down payment funds. Today's video really going to be covering the qualifying income portion. So this is kind of a little known, you know, it's not really like a hack. It's just part of the guidelines, but it's sort of buried in the, you know, the Fannie Mae conventional loan selling guide, as they call it, which is really just, you know, the Bible of Fannie Mae lending, conventional lending. So we are going to go ahead and talk about the two different ways. There's really two ways that come to the forefront of my mind when taking a look at this option. So you've got your QM option, and then you've got your non-QM option. So they each have their pros and cons. QM is just, it means conventional loan. So it's a Fannie Mae conventional loan, and the other one is non-QM. So it's from a private lender. So and you've got your employment related assets as qualifying income for the QM loan, and then you've got your asset depletion program is what it's called with the non-QM. So let's talk about what that means in English for you guys, and then show you how, you know, it would benefit you and things like that, so that you know, you don't hit a roadblock here in, you know, whether did an early retirement or something like that, or maybe, you know, maybe you've got a lot of money in the retirement account, 401k, IRA, whatever it is. But maybe you recently switched from W-2 wage earner to a 1099 wage earner. You know, as you advance in your career, you know, these opportunities come up, and, you know, sometimes the money is so much better as a 1099. But you know, you can't use that 1099 income for qualifying income purposes until you've had 2 years worth of it in most cases. So, you know, so you got the better pay, but, you know, you can't use it to buy a house. So what are the other options? So let's dive in right here. So with conventional loans, this is the one, if you can use the conventional option right here, chances are you probably do want to go ahead and use that. The rates and terms and everything is going to be better. You know, the cons are that it's a little bit more restrictive than the straight asset depletion program, but this is going to be your regular conventional Fannie Mae loan. So here's sort of how it works. When we look at, you know, let's say you're trying to buy a $300,000 house. We'll use that for the calculation purposes right here. You're trying to buy a $300,000 home, but you retired from your job, so you technically don't have the qualifying income coming in anymore to calculate your debt to income ratio, which is, you know, how we get to your max purchase price. So the asset requirements right here, this is where it starts to kind of get interesting. They got to be liquid and available, you know, so they have to be able to be accessible. So, you know, the whole goal here with any kind of mortgage lending, and, you know, of course, we are an equal housing lender, you know, licensed from coast to coast. We do loans in all, you know, 48 contingent states. And, you know, I'm mortgage broker Mike Easton here at Movement Bank. And so mortgagebrokermike.com, shameless plug, you know, reach out. Let me know if I can help you with any other mortgage questions, or if you want to go ahead and proceed with something like this, we can certainly dive in. So they have to be accessible, and the purpose of doing something like this is to prevent against foreclosure. So we never, ever want to put anybody in a situation where they cannot repay the loan. That is the worst thing any lender would ever want to do. It's totally predatory. If you can't afford to pay back this loan at some point here in the future, you know, you're probably not going to get the loan, because you're not going to fool the underwriters, right? So it's got to make sense, and it's got to be good for you. You know, we don't want to do anything that would ever jeopardize anybody's, you know, financial stability for the future. So looking at 401k, IRA accounts, you know, any kind of retirement account that's an employment related asset. So that's sort of the key word there. So if it's just cash in the bank, that's not an employment related asset. That would fall under, you'd have to use the asset depletion program. If you've got, you know, $1 million worth of stock in Google that you just bought, that's not an employment related asset. That would fall in the asset depletion. You'd use the non-QM loan for that. So they each have their use cases, and I could certainly decipher that, help you kind of go through which one it truly is. So we take a look at that. It has to be all accessible. So, but you don't have to draw from it, straight there, because you're going to take penalties and all kinds of stuff. You don't want to do all that. It just wants to sit there and stay there and live there and be happy. That's where it is. It's its home. It's in the 401k. We don't want to disturb the money's home. So take a look at some of the penalties. You guys can read this stuff. I'm not going to read through every little line of jargon because a lot of it's not really applicable. So where we do get into more of an applicable situation here is when we talk about net documented assets. So that's what's going to come into play for the actual calculation. So how do we figure out what that number is and what can we actually use? So let's take a look. Here's a sample calculation method right here. I've got 500,000. We're gonna use a slightly higher number right there because a lot of times that number, this total starting number, it is a lot higher than 500,000. So for purposes here, let's just call it 2 million. We've got $2 million in that department. So we're going to start there, and then they're going to say minus your fees. So how much does it cost to actually, if you were to draw this money today, what's the penalty? How much does it cost? Tax penalties, yada, yada, yada. So they're going to assume a 10%. Yours will be higher, yours might be lower, but for here, we're just going to estimate 10%. So times 10%. So 200,000, we're going to back that out, because if you're going to have to get whacked on that, that's going to be a fee coming out. We're not going to be able to count it, because when it comes down to it, if you had to repay this whole thing, can you do it? And so that's what they want to true. They're trying to get to that true number right there. So we're going to take 2 million minus 200,000. All right, we're at 1.8. Now, that's your total eligible documented assets right there. Now, let's talk about funds required for closing. So the two different loan programs here, we're talking QM, conventional, Fannie Mae loan right here. The requirements are going to be, you can either do it, you either need 20% down or you need 30% down. And let me see if I can show you guys here, which would determine, oh yeah, here it is right here. Okay, so the loan parameter, maximum loan to value. So loan to value is just kind of the down payment percentage in reverse. So 70% LTV or 80% LTV. We take a look. So you would have to meet this. You could 70% is this. That's the baseline program eligibility. So you need to be putting 30% down on the purchase price. So on a $300,000 home, your down payment there for the 30% down would be $90,000. Of course, in closing costs and everything like that, application fees. Or you could do 20% down if you meet these stipulations right here. So let's move my beautiful face out of the way and let's read through them. So if the owner of the assets is at least 62, if it's jointly owned, oh, there we go. That was weird. The owner of the assets is at least 62, or you meet this, the other rest of this jargon. So if you're 62, chances are you're probably taking distributions off of the 401k, but that is not always the case. So we're just going to plan for 30% down right here, path of least resistance for you right there. So let's pull back up the calculator and minus funds required for closing. So 30% down, that's 90,000. So let's back it out. And actually, you know what? We're going to round up to 100,000. We're going to cover closing costs, fees, application fee. That's an estimate, but we're just going to round it up, call it 100. Error on the side of caution. So 1.7 million remains. And then we're going to see down here, then they want to back out an additional 30% off of what's left here. It's kind of like an incidental just to calculate and get this ultimate number that we're going to end up calculating here. So they're going to wipe off another 30%. So times 30%. There we go, 510,000. So we're going to go 1.7 million minus 510. We're left with 1.19 right there. So That is how we arrive at the net documented assets right there. Now, what does that mean? Right? We got this number. It's smaller than the original one. So, the fancy way to quick calculate this is sort of just take your retirement assets, whatever is in there, divide it by 2, cut it in half. You get close. So you don't want to do all that math and stuff. That's how you get to your net documented assets quickly. It's just sort of an estimation because it's approximately half. Not quite though. But here we go. Monthly income calculation. So from there, you take your net documented assets and divide that by the loan term. So a 30-year mortgage, 30-year fixed, or it's 360 months. So that's your loan term. So let's say you want to do 30-year fixed right here. Let's see what that looks like. Divided by 360. Let me just write that number down. 119. All right. Get that written down just in case. 360. It's the number of months in a 30-year fixed. That would put your qualifying income in this scenario, your qualifying income that the mortgage lender, loan officer, mortgage broker like myself would use to submit to underwriting. We would submit this number right here, $33.05 per month. So what that looks like is that's your, that would be as if, you made that much money gross income per month right there. So you take that would be kind of equivalent to, if you multiply that by 12, we can kind of factor that for an annual salary, be about a $40,000 annual salary equivalent. So that would be how much you could use. So to buy the home. So what does that mean? $33.05 per month. $33.05 per month qualifying income. Well, now we're going to take that one step further. The debt to income ratio would be the, we would need to take that and look at it compared with the debt to income ratio to make sure that those numbers work. So times the maximum top of the line debt to income ratio for a conventional loan is 49.999%. It is tough to kind of get an approval up at that range, but we're going to multiply it by 50%. So that would mean that the maximum amount of debt that you could have total with all your cars, student loans, credit cards, and your home right here, maximum amount of debt would be $1,652 per month. So that would include your principal, interest, taxes, insurance, HOA dues, and everything else. So you're probably your monthly mortgage payment that you could get, if you had a couple $100 in debt per month, debt service, that let's say you could, your total mortgage payment, principal, interest, taxes, insurance, HOA dues, PITIA, let's say that number is like $1,200 a month for all that for the housing, and then you've got maybe $300 in monthly debt that you carry. In addition to that, well, then your total debt there would be $1,500 a month, and you're under this number right here. So that would mean that in this scenario, you would qualify for however much home that would purchase, at the rate and terms and stuff like that. So we would have to dive in a little bit deeper to figure out exactly what that looks like. But when you're putting 30% down on a $300,000 home, that's going to take your monthly payment down. So let's say that number doesn't quite work. Let's say the ratios are too tight, can't do it. Okay, great. What are the other solutions? So take a look here. You're taking that net documented assets and you're dividing that by the number of months in the loan term. So 1.19 million, that was our net documented assets number when we had $2 million to start. And let's go for a shorter loan term, right? So instead of 360 months, we're going to go, let's say we want a 15-year loan because we're going to pay this thing off quick. We're going to get a better rate on a 15-year fixed than you are on a 30. There's no secret there. The bank's going to make their money back quicker, so it's all good. You take that and you divide it instead of by 360 months for a 30-year, we're going to divide it by 180 for 15. Oh, okay. Now we have a lot more qualifying income, don't we? So you're going to have more there. Of course, your payment is going to be higher on the 15-year loan, but the rate will probably be better as well. So you kind of you give and take a little bit, kind of shake the numbers around, shuffle the cards a little bit, see what works, see what looks real nice. So then we'll take a look at the debt to income ratio calculation, and see if we can just arrive at some favorable terms for you guys. We can kind of, mix and match and slice and dice and make everything work. So yeah, these are the guidelines, and here for that. There's of course some other stipulations, but if the key word is really employment related assets as qualifying income with a conventional loan. So that would be one way to use your 401k to buy a home. You could pull from the down payment funds. I would assume you would probably just pull those straight out as well, unless you had those cash in the bank. Now let's talk about the other option. It would be a non-QM option. So these terms, as you can see, they kind of get a little restrictive there, with the way that they're carving everything out, carving down all the income, slicing it all away. So let's take a different approach, slightly, shift gears a little bit and talk about more of a straight asset depletion approach. So with the asset depletion program, you can, and let me put this up here so we can take some notes as well. Asset depletion, you can use 100% of your checking and savings accounts and money market accounts, and you can use 70% of the remaining value of stocks and bonds and 60% of the retirement assets. So your calculations here with these guys they're a lot more lax over here. So you might end up qualifying for more with an asset depletion loan through a non-QM lender. So and actually, the pros of doing that as well is the minimum down payment just starts at 20%. So you don't need to put 30% down. Of course you can if you want to, but you don't have to. And honestly, I compared the rates between the two of these here, and the rates with the asset depletion program are really not even that bad right now. So they're pretty comparable to the conventional loans. In fact, they're pretty comparable with some of the interest rates I was closing last fall, with the rates where they were. So, sometimes you think, oh, private lender, you're going to be gouged on the interest rate and, adjustable rate and all this other stuff. There's a lot of different options that we could do. So you really end up with really the look and feel of a regular loan, which is great. Of course, it'll all be disclosed to you when you do get there, but 100% of the checking and savings account. So let's say you've got, 300K in the bank, and then you've got, maybe you got 100,000 in stocks and bonds and all that kind of stuff. So you take to 70% of that. And I'll put some commas in here so it's easy to read. And then 60% of the retirement accounts. So let's say you've got, let's say maybe you don't have 2 million in the retirement account. Maybe you have 1 million. So 60% of that be 600,000. Or we'll do slightly higher. Let's see, you've got 1.5 in there. So 1.5 times 0.6, 900K, just like that. And of course, these numbers change every single time. So they'll never just be, chips will never just fall just like that. But let's take a look. So right there, you've got 1.27 million right there. So 1.27 is your total amount of assets that you have. And what can we do with it? How does that work? How does that factor into the income calculation method with this type of program? So it is slightly different, but it is a lot of times more favorable, and you're going to get a higher monthly qualifying income amount, which is going to dictate the debt to income ratio, which will increase your purchase price potential that you can do. So they have a couple of different calculation methods. So I'm just kind of reading through them on the other screen so I can translate them over into the calculator to make it an understandable thing. Because it's hard to download all the information I know about the mortgage into a digestible English format. So I'm doing my best for this educational session. So borrowers must have the lesser of 1.5 times the loan balance or $1 million in qualified assets. So we've got the $1 million in qualified assets. So we're good there with that baseline requirement. But if you're doing, 1.5 times the loan balance, on a $300,000 home, you would need to have at least $450,000. Well, I guess the loan balance would be 240. It'd be 240,000. So you need to have 1.5 times that in order to qualify for the loan, just at the baseline elementary level. But of course, if you're using it, you're going to have that most likely. Otherwise, it's not a real option. And so then the income calculation goes for this method. It's just net qualified assets, which we arrived there at that number a lot easier and a lot more favorably. Net qualified assets divided by 120 months. So divided by 120. Boom. Now, qualifying income is $10,583 per month. Because the bank knows that with it's all said and done, you've got all these assets. If you really wanted to, you could just pay off the loan. You could just pay off the loan straight up and be done with it. So that the risk of foreclosure, when somebody can just pay off the loan, the risk of foreclosure, historically speaking, is very low when you can do that. You never want to endure a foreclosure if you can avoid it somehow, some way. So the risk is historically pretty low. So that's how they calculate the qualifying income there. Boom, 10,500, qualifying for probably whatever home you want for the most part, unless you're in a higher dollar market. So there's another option that they can use to calculate. So then the option 2, qualified assets must be sufficient to cover the new loan amount, down payment, closing costs, and required reserves for the loan program, which is usually about 6 to 12 months, principal, interest, taxes, insurance. You need to have that, and 5 years of current monthly obligations. So then there would be no debt to income ratio calculation on that second option. So because instead of taking a debt to income ratio approach, which is what 95 out of 100 loans will use, a DTI approach, they look at it more of like a on paper common sense method, and it's like you've got the money to pay it back. So let's see what that would look like. So cover the new loan amount, down payment, closing costs. All right, so if the loan amount would be, your qualified assets must be sufficient to cover the new loan amount. So the new loan amount is going to be 240. If you guys require 20% down, and down payment, closing costs, and so down payment was 60,000. So there's that. Closing costs. Let's say that's just call it 10 grand. Let's say they're really high. Required reserves. Let's say the reserve requirement, let's say it was like total monthly payment was like $1,500 a month times 6 plus 310 is what number we just had, and 5 years of current monthly obligations. So current monthly obligations, that's stuff that's reporting to your credit report. So if you have I don't know, $500 a month in monthly debt times 12,000 times 5, 30,000 right there. So we're taking a look, 319 plus 30,000, so about 350 plus your mortgage payment for 5 years as well, and we'll throw that in. If it's going to be 1,500, 18,000 times 5. Wait, no, back up a little bit. So many numbers flying around. Oh wait. Yeah. 5 years. Okay. 18,000 a year in monthly mortgage payments annualized, and then times 5 years to carry that. So you got 90,000 plus the 349 and 439. So this option 2 would just simply require they wouldn't look at the debt ratio. They do a total asset calculation method. If you had $439,000 in total qualifying assets, then it appears that the qualification parameters for the asset depletion program with that calculation method would be met. So you'd be buying a home, and you wouldn't be waiting around until you were waiting for those disbursements to come through or anything like that. We'd just be rocking and rolling, moving straight forward. Go ahead and get you pre-qualified. Of course, full credit review, run the credit, look at income, assets, bankruptcy, foreclosure, any of that kind of stuff. We want to know it all, and you'd be moving in the right direction towards your next home. So hopefully this video was informative for you guys, and it might help to kind of dispel some of the misinformation that may be out there. Maybe you heard something else from somewhere. Everybody's got different loan programs, and they change like every couple of weeks. All the different thousands of loan programs change their little minuscule guidelines. There's thousands and thousands of pages of them, each different one. So it's a constantly evolving market. So knowing how to utilize this information properly, and find it, and be able to access it on the go, and then utilize it and harness that information for your benefit. And if you're a realtor, for your client's benefit, having access to someone that can do these types of out of the box things is going to allow more deals to close, and it's going to allow more families to be served, and just doing good things all the time for as many people as we possibly can, helping families get home. So thanks for watching, guys. Be sure to like this video, comment below, let me know what you thought. And if you do want to see some more content, real estate mortgage tips, and just kind of credit score increase tips, be sure to subscribe to my channel as well, because I just reactivated it not too long ago, and I will be planning to put out quite a bit of hopefully really relevant content. So thanks, guys. Mortgage Broker Mike signing off. Have a good one.